Hello and good day to me, Sim. We are from Group 3 and today we will present our ACE390 group assignment. Our presentation focuses on tax planning of backbone manufacturing Berhad. Our group consists of 5 members, which is me, David Cheng, Ong Jing Wei, Tan Jing Yao, Wong Yong Chen, and Yip Chi Fong.
I'd like to start by introducing Backbone Manufacturing Berhad, or BMB, which is a publicly listed Malaysian company specializing in electronic and electrical components. They operate a manufacturing plant in Penang and serve both domestic and export market. With authorized share capital over RM2.5 million, BMB is classified as a big company and is subjected to full corporate tax rate of 24%. BMB operates as a holding company with a wholly owned subsidiary, Wu Precision Senior Berhad, which supplies precision parts internally. This group structure was efficient but introduced several tax challenges, which included conflict between claiming group relief and investment tax allowance, transfer pricing risk due to the intercompany transactions, inefficiency in SST on internal supply, and unutilized tax losses in the subsidiary. Compliance is governed by the Malaysian tax law and regulation, including the Income Tax Act, Sales Tax Act, Transfer Pricing Guideline issued by LHDN, and etc.
Now, I will cover the problem statement. First, we are having a tax leakage issue. Our holding company BNB is charging at a tax rate of 24%, while our subsidiary BPSB is making losses, and hence, those losses are trapped. The group is paying relatively higher tax amount than necessary. Secondly, we are facing a strategy conflict also. We are actually claiming group relief to utilize those losses, but we also want to utilize the ITA investment tax allowance for our new automation machines. Legally, we cannot claim both of it, but we need to trade off based on which options actually can help the group to save more money. Now, our biggest problem actually is transfer pricing matter. We are lacking of proper documentation to prove our intercompany deals are at actually arm's length. This exposes to a significant serious audit risk and a potential of 5% of surcharge penalty. Operationally, we are currently not efficient in avoiding SST in intercompany transaction also, as the Schedule C exemption is not being effectively applied. Finally, invoicing preparation is behind due to our legacy ERP system limitation to support the LHDN requirements, which result in non-compliance penalties.
So I would like to talk about the methodology. This study uses a structured mixed methods approach. We analyzed BNB's case with hypothetical financial data, cross-reference against real Malaysian tax law, including the Income Tax Act, Sales Tax Act, Promotion of Investment Act, and LHDN guidelines.
So, at very first view, let's come to the tax computation analysis. We have started with a net profit before tax of 8 million, and after adjusting to ensure compliance, our final tax payable is actually calculated at approximately 1.2 million. The key contributor for tax deduction is the capital allowance of 2.64 million. This is such a big amount for tax deduction due to the investment in factory automation machine. This deduction significantly lowered our taxable income. Also, note that we included a small surcharge of transfer pricing to ensure compliance. Now, let's look at why the number changed. The biggest amount is replacing the accounting depreciation with capital allowance, because we bought a new automation machines which allow us to claim IA initial allowance and lead to the higher tax deduction amount of YA2025. Besides, we also maximize our deduction by utilizing 1.5 million in total losses, which are combining our carry forward losses and the current year losses from our subsidiary BPSB. Luckily, there are also a franking dividend remitted into Malaysia, which is not subject to the tax of the year.
Hi, I'm Yong Cheng. I will continue the presentation. Now let's look at a critical compliance issue here, transfer pricing. As BNB pay a management fee to its subsidiary, we want to avoid any audit issue with LHDN, so we took a proactive approach. We voluntarily adjust the tax computation and pay a 5% surcharge, which is 25,000 ringgit. We view this as a safety cost to prevent a future penalty. We must prepare a full transfer pricing documentation to prove that our prices are fair. Move on to our expansion strategy. Since we are invest 5 million ringgit in automation, we successfully qualify for the investment tax allowance. Based on our calculation, this entitled us to an allowance of 3 million ringgit. And the best part, we can fully utilize all of it this year. This strategy alone generates a massive net tax saving of 720,000 ringgit. Without that, this is the most powerful tool in our entire tax planning. Move on to the SST. On this sales side, we are actually doing quite well. Thanks to our export assumption, we have successfully saving a 1.2 million ringgit. However, we are facing a lacking on the purchasing side. Currently, we are still paying a sales tax when we buy part from our own subsidiary. This creates a tax-on-tax effect that hurt our margin. Our recommendation is simple. We must apply for the CJ5 assumption immediately. This will allow us to buy raw material tax-free, directly improve our group cash flow. Finally, we come to the big strategy decision. Since we cannot claim the both incentive, we have to choose one. We did the math, and the difference is huge. For option A, group relief, only save us 168,000 ringgit. But option 2, the ITA saved us 720,000 ringgit. The winner is clear. We strongly recommend claiming the ITA. It saves us 4 times more tax. As for the subsidiary loss, we won't lose them. We will simply carry them forward to use in the future. The strategy is maximize the group total value. Thank you.
Next, we will continue two discussions. Firstly, capital allowance and tax incentive play a key role in reducing bamboo manufacturing per head tax payable. Although depreciation in financial statement is not deductible for tax purpose, therefore, tax relief is given through capital allowance. In this case, bamboo investment in automation machinery are qualified for investment tax allowance. This allowance allows the company to grant higher tax deduction in the early year. This improves cash flow and support further reinvestment. Our analysis show that investment tax allowance generates tax saving of 720,000, which is significantly higher than other available relief. Next, good relief allows losses from a subsidiary to be transferred to a profitable holding company. While bamboo can grant 700,000 of losses from its subsidiary, the tax benefit is relatively limited. More importantly, tax rules do not allow good relief and investment tax allowance to be granted in the same year. As a result, management must choose the option that delivers the greatest benefit. Selecting investment tax allowance is a rational tax planning decision, as the subsidiary losses can still carry forward for future use. Thirdly, transfer pricing is a significant compliance and ethical issue for bamboo manufacturing Berhad due to substantial transactions with loss-making subsidiary. During the year, bamboo paid 500,000 in management fee and purchased precision part from its subsidiary. Under Section 140A of the Income Tax Act, all related party transactions must be conducted at the arm's length, meaning that price should reflect what independent party would agree under similar situation. Based on the analysis, bamboo proactively recognized RM25,000 transfer pricing such as to align each charge with arm's length principle. This reduces risk of audit adjustment and the penalty by LHDM.
The problem with not applying for CJ5 exemption is tax leakage, which unnecessary taxes are paid. This is because BMB is a registered manufacturer and is allowed to receive SST exemption on input supplied by the parent BSNB. Besides, the exemption is also applicable on exported goods too, since the exemption as per the written act wrote finished goods, not just taxable finished goods. And this can be supported by a real case involving Hong Leong Yamaha Motor versus Ketua Pengarah Custom Malaysia. Moreover, foreign sourced income is also eligible for exemption under Schedule 6 of Income Tax Act 1967, as long as requirements shown in the slide here is fulfilled.
Next, we continue to recommendation. Firstly, recommendation of capital allowance. It is recommended bamboo prioritize investment tax allowance over good relief in YA 2025 as ITA provide higher tax saving of 720,000 and improve short-term cash flow. Besides, bamboo should continue to grant capital allowance on all qualifying assets to maximize tax benefit. Furthermore, bamboo should consider MAC plan before buying new assets or automation equipment. For example, companies should verify whether the investment can receive any tax benefit, such as investment tax allowance, to maximize the tax benefit. Furthermore, all capital allowance grant must be supported with invoice, asset register, usage record, with periodic review of unused investment tax allowance balance to avoid non-compliance or forfeiture. Next, recommendation of good relief. Although the holding company allowed to utilize the subsidiary losses, but bamboo should not utilize the subsidiary losses in YA 2025 due to incompatibility with investment tax allowance. Therefore, the subsidiary losses should be carried forward for future use when investment tax allowance is no longer granted or when the company subsidiary become profitable. To mitigate this, bamboo should closely monitor loss expiry period and regularly forecast subsidiary profitability. Therefore, implement a good wide loss management policy will help ensure losses are utilized within 10-year limit. Furthermore, we continue to recommendation of transfer pricing. For transfer pricing, bamboo should ensure all intercompany transactions are conducted at arm's length. Appropriate methods such as DOP for good, transactional net margin method for service should be applied with annual review to reflect market condition. Because the high-risk nature of transition between profitable company and a loss-making subsidiary, Bamboo should certify the benefit test and maintain proper documentation at the same time, strengthen their internal control and staff training about the transfer pricing.
First recommendation is that BNB should apply immediately for the Series 5 exemption to eliminate SST levy on intercompany purchases and inputs for exported goods. And if possible, perhaps some activities can be routed through special areas for SST relief as well. Also, do ensure that SST documentations are well kept to defend against any tax challenges by the Director of Inland Revenue Board. Second, BNB should strategically plan the timing of dividend repatriation to ensure that the dividend income received in Malaysia is within the exemption period ending 31st December of 2026. And the company should also evaluate applicable double taxation agreements to reduce foreign withholding taxes on dividends and avoid double taxation where the exemption conditions are not fully met. To mitigate the risk, BNB should closely monitor HDM rules and updates and prepare contingency plans for post-2026 scenarios, such as focusing on reinvestment rather than profit repatriations. Lastly, BNB should also adopt the application programming interface for their e-invoice processing, as it is more efficient to process the high volume transactions of their operations. And to mitigate the risk, they should also implement strict internal controls for accounting processes related to cancellations made after 72 hours of e-invoice submission for validation to avoid errors or further complications in accounting records.
This case study shows that the corporate tax planning is crucial for Malaysian manufacturing companies. While compliance is important, it is not enough for tax efficiency. BNB needs to strategically balance tax incentives like investment tax allowance, which provide greater tax saving than group relief during high capital expenditure years, with proper compliance management. They must address transfer pricing risk through proper documentation and arm's length principles, optimize SST exemption to prevent cash flow losses, and ensure foreign income planning follow ethical control. Ultimately, effective tax planning must align with genuine business activities, supported by strong governance and documentation.
Thank you for your listening.